Hi there, I'm Winnie, co-founder of Hoc-trade. Welcome to part 2 of our analysis of crypto versus Forex, in which we outline all the important difference of the crypto versus Forex market for retail traders. In part 1 of the video, we already covered the dimensions of volatility, liquidity and market value, fee level, pricing mechanism, and asset variety. The link to the first video can be found up here and also down below in the description. In this second part, you will learn about asset dominance and correlation, exchange and broker availability, available leverage, trading software, and available trading hours in the Forex versus crypto trading market. Without further ado, let's jump right into it. The sixth dimension of our Forex versus crypto comparison is the asset dominance and correlation. Looking at the trading volume, it becomes clear that the US dollar is by far the most traded currency in the Forex market, with roughly 44% of market share, followed by the euro with roughly 16%. In the crypto market, and excluding the dollar-patched coins such as Tether, USDC, and BUSD, Bitcoin is by far the most traded coin, followed by Ethereum. In both markets, the top two assets holds a very large share of the trading volume of 60% and more. What is a big difference in crypto though is that the majority of coin is following the Bitcoin movement to a large extent. So, if Bitcoin shows a sharp increase for the day, the likelihood that Ethereum and all the other coins also show a sharp increase for the day is very high. Having a look at the correlation metrics for the last year, we can see that especially Ethereum and Cardano shows very high correlation with Bitcoin. Therefore, if trading crypto, you need to be aware of the Bitcoin movement in order to fully understand the price movement of many other coins. On the other hand, in Forex trading, you always trade one currency against another, hence the relative strength or weakness of a currency is also very important. You need to be aware of the correlation in Forex trading. However, mostly in the way that the USD or any other currency might be the same quote or base currency in another pair you are trading. For example, when being long in both the EUR-USD and USD-JPY, a strengthening US dollar will have a long effect on your first position while you're having a short effect on your second position. As you can see in the Forex correlation matrix, the EUR-USD versus USD-JPY has a strong negative correlation. So, both in Forex and crypto, retail traders need to be aware of the underlying correlation of the asset they are trading. In crypto, the correlation to the Bitcoin movement is especially important. While in the Forex market, you will have to watch out for the correlation of your base and your quote currency, which you are trading. Personally, I tend to think in macro and micro environment of a coin when trading crypto. Macro environment is the general market development with Bitcoin as a proxy, while the micro environment are project-specific things such as new development, revenue generation, news, and so on. The variety of assets is especially attractive in crypto. With so many coins and so many different micro environments possible to trade, which is less possible in the Forex market. In the seventh dimension, we are having a closer look at the broker and exchange availability and dominance in the crypto and Forex market. As mentioned beforehand, the Forex market is a very mature market which has been around for a long time. The Forex brokers are mostly well regulated in the different juristic areas. Different to the crypto market, there is a very large number of Forex brokers around without any one or two very much dominating the market. There are plenty of brokers with like 1, 2, 3, or 4% market shares, and overall, Forex trader can choose from hundreds of brokers with probably 20 to 30 pretty large and well-regulated ones. Similar to the crypto market, the United States is a little different as not many brokers are regulated there. Both for Forex and crypto, there are only a couple of brokers and exchanges available for traders to trade at in the state. In crypto trading, in general, there are much less exchanges a trader can pick that has sufficient liquidity, provide future trading, and have a decent product offering for the user. Binance holds a very dominant position for crypto traders, especially after the FTX meltdown. The FTX meltdown showcased the risk of crypto market very well, as the market is much newer and of course less regulated so far. We did a video explaining what happened at FTX and what is needed in the future. I will link the video up here for you and also down in the description. There are a couple of exchanges lined up in the following position challenging the dominance of Binance though. And it will be very interesting to see how the market share develop in the future, especially also with the rise of decentralized crypto future trading exchange. The exchange landscape might align to the Forex broker market structure with a maturing industry. However, as of right now, traders still have a much wider variety of suitable broker in Forex trading compared to crypto. The eighth dimension of our Forex versus crypto comparison is available leverage. Leverage again is a double-edged word. While it can significantly push the profit of your trades, it also amplifies your loss and risk of being liquidated. While the available leverage in the Forex market is higher, in some cases, leverage of 300, 500, or even more is available. The Forex market is also more regulated as mentioned earlier. The available leverage differ by jurisdiction you are in and your level of experience in trading, of course. For example, in Europe, the leverage to retail trader is limited in Forex trading, while some countries do not regulate the use of leverage. Overall, the leverage available in crypto trading is lower. Most crypto exchanges allow leverage of 100 times or less, oftentimes also depending on your position size as in the case of Binance. Moreover, crypto holds another difference to Forex trading, which Forex traders usually are not aware of. Most crypto exchanges differentiate between cross-margin and isolated margin trading. Simply put, for cross-margin, all your coin holdings serve as available collateral, while in isolated margin trading, only the coins held in a specific wallet in a specific coins are regarded as margin for your trade. Many traders use the isolated margin as an additional risk management tool so that your position might not affect other holdings in another wallet. For Forex trading, such differentiation is not common. So, is the Forex market more attractive for traders as the available leverage is higher in many cases? Well, there are two factors to consider. First, the volatility in crypto trading is much higher in compared to Forex trading. So, while your leverage might be lower, the strength of market movement can well make up for the lower leverage. Second, leverage is just a tool for a trader that has an impact on the margin you will have to hold for your trade. If you are trading and not gambling, hence have a sound risk and money management, the available leverage at crypto exchanges should be more than sufficient. Let's take a rather aggressive example. You have $100 balance and don't risk more than 2% of your balance per trade. You have 5 trades open at the same time, so your total risk to your account is 10% based on your open position. A 0.5% movement in the underlying asset you trade should equate your maximum risk of 2% per trade. And remember, for highly volatile assets such as crypto, a 0.5% move is really not much. Therefore, in order for 0.5% move of an asset to lose 2% or $2 of your total balance, you need to buy the asset for $400 each. With 5 position, you will hold assets of $2,000 in total, while your account balance is only $100. If your exchange allows you a 50 times leverage, you need to hold $40 as margin to open those 5 positions, still giving you another $60 of free capital. Even if all the positions are lost trades, So you'll lose 10 USD in total. You still have 50 USD or 50% of your overall balance as free margin. And your position would have been normally stopped out and not forcefully liquidated due to missing margin. As you can see, even in this quite aggressive scenario, and with leverage of 50 times, the available leverage would have still been more than enough, even though 50 times and much less compared to many Forex broker. So yes, in crypto, the available leverage is less. However, it should not really affect a trader with a sound risk and money management system in place. The ninth dimension of our Forex versus crypto trading comparison is the available trading software. The Forex market shows quite a strong concentration of the MetaTrader trading software, which in its two models, so MetaTrader 4 and 5, makes up the majority of trading software used in the Forex trading. Nearly all large brokers enable traders to use MetaTrader. Many brokers also offer cTrader or their own proprietary trading software. However, the vast majority use MetaTrader. No matter which exchange you use, a trader will be mostly able to use their familiar trading software, have their safe chart type and indicator set up. In the crypto market though, such a common trading software tool does not exist yet. Every exchange has their own proprietary trading software in place, making a switch among exchanges more difficult for traders as they have to get used to a new software. While the trading software of course enable all the necessary functionality, the details are different. And when actively trading, one doesn't want to search for a certain information or buttons. The 10th and last dimension we are looking at in today's Forex versus crypto trading comparison is the available trading hours. The Forex market operates 24 hours, 5 days a week, while the crypto market is open 24 hours, 7 days a week. Both markets enable trading during the American, European, and Asian session with their very specific market characteristics. While taking breaks and relaxing is super important as a trader, being able to trade on the weekend in the crypto market might hold some additional upside for traders. Depending on the trading strategy, trader may like those times with lower volatility and less institutional market participants active in the market. On the other hand, as the market is 24/7, there's no gap trading possible as the market never closes in the crypto market. Overall, the available trading hours in both markets are plenty, with some more availability for crypto trading due to the possible weekend trading with slightly different market characteristics. But the risk of never being able to fully rest, here again, strict time management trading rules are required for traders. Before summarizing all the content of our Forex versus crypto analysis, if you are or you're thinking of becoming an active trader and you like the content of this video, please leave us a like and subscribe to our channel with the notification bell on. We develop lots of content for traders and soon our behavioral analytics software will go live, which enable traders to understand their very own personal profit and loss-making patterns. When subscribed, you will directly know once we upload all the new content for traders. So, what is especially attractive about trading crypto for active retail traders? Crypto assets shows on average a much higher volatility, giving opportunity to grasp those movements in either short or long-term trades. Crypto traders also benefit from a much larger variety of assets, which have their very own microenvironments leading to price movement. The available leverage is lower in crypto trading compared to Forex. However, it should be more than enough for traders with a sound risk and money management system in place. Moreover, the 24/7 availability of crypto trading enable additional strategy for weekend trading with much less institutional market participant active, and if rising in the exchange tiers, crypto traders can significantly reduce their fees. On the other hand, crypto trading also has its downside for traders which favor Forex trading. Most significantly, for very large traders, the market liquidity is much deeper, allowing for larger position size. The fee levels in Forex trading are significantly lower, which can well make up thousands of US dollars, which crypto traders have to get on top if wanting to keep up with Forex trader. Additionally, Forex trader benefits from much more mature market with plenty of trustworthy and competitive broker enabling good trading conditions and do not have to adjust to new trading software every time they want to change their broker or trade at multiple brokers at the same time. Overall, both markets have their upsides and also downsides, but your need as a trader may well give the edge of the one over the other. Alright, I hope you enjoy our Forex versus crypto analysis. Have good trades, stay humble, and be safe. Cheers! Please be aware that we at Dr. Fee are no financial advisor. This video is for entertainment purpose only.